All right, hi everybody. Welcome to Unit 4. We're talking about money and banking and monetary policy. This is all brand new information to you. It's a huge segment of our economy, and we haven't talked about it a lick. So there's going to be a lot of brand new concepts here, but don't fret, don't worry about it. We'll repeat these concepts over and over again. And just like in previous units, the logic will really start to make itself clear once you kind of get over the barrier of the new language and definitions that we're using. We'll get there, I promise you. Let's get into it. Topic 4.1 is financial assets, and that's the focus of our video today. When we're talking about financial assets, first of all, what is a financial sector? It's a whole segment of our economy that's dedicated to the borrowing and lending of funds. People like you and I, when we put our money in the bank, that bank then takes that money and lends it out to other people. And that's a really important part of our economy because people like you and me use that money to buy cars and houses, things we can't afford cash for most of us. And then businesses use it to build new factories, expand their production facilities. And then the government uses it to fund major building projects and the military and things of that nature. So it's really, really central to keeping the juices flowing in our economy when maybe normal spending isn't possible, right? In order to do this, we operate all this on interest bearing assets because it's all about lending money. When we lend money, we charge interest on the money that is lent. And then people like you and I can purchase a portion of those lent funds and get the asset or get the interest in return. So we call those interest bearing assets. Let's break it down. An asset is anything that has intrinsic value to it. So if I own equipment, that's an asset. If I own cash, that's an asset. It has value to me. I can exchange it for money and then use that money to buy other goods and services. It's liquid, in other words. We also have interest. What is interest? Is the price of a loan, is basically what this is saying, right? Lenders charge an amount for the privilege of borrowing money from them. That's interest. And that's how they offset the risk of giving you that money and make profit off of it as well. So you put all that together and it's called an interest bearing asset. It's an asset, something that has intrinsic value, that has that value because it owes you interest in the future. Somebody's going to pay you back the money for that asset plus the interest that is owed. And that's where the true value of that lies. And people like you and I invest in these interest bearing assets all of the time as we're planning for the future. Okay, so a couple of clarifications for you. We'll move through these pretty quickly. Investment. When we use the term investment, we're talking about the purchase of capital goods, not investment in interest bearing assets. That's not it. When we talk about personal finance, which we're talking about right now, this is individuals making budgeting, spending, and saving choices that impact our economy or impact this financial sector. So when we talk about those things, they're purchase of assets, they're not investments. You're purchasing the asset, it will pay you back money plus interest in the future. That's why it's an interest bearing asset. It is not investment. Even though people always say, I'm investing in the stock market, economists don't call it investment. Economists say you purchase financial assets. Okay? So we're going to try to use that terminology here so we don't get confused. All right. When you're purchasing one of these interest bearing assets, you're doing it because you want to make money in the future. I give them money today, and I'm hoping that in the future I get that money back plus interest, which is why it has value to me. I just say, you know what? I don't need this money immediately. I'm going to put it over here, and it's going to pay me back plus interest, and I'm going to retire on that money or something like that. Or I'm going to use it to buy a yacht. I don't know what your situation is. But there are risks involved to this. So, what are the three major risks of purchasing interest bearing assets? First is the market risk. It is possible that our economy collapses because of the business cycle. We fall into a recession or a deep depression. For example, several people that own interest bearing assets during this pandemic period have lost a whole lot of money over that time. So, that is one very real risk. The second one is people can just not pay you back. An asset or an interest bearing asset is actually an IOU. People are borrowing money and they're saying, I'll pay you back plus interest in the future. I owe you this, oh yeah, and a little bit extra. But whenever you let somebody borrow something, it is possible that you don't get that something back. Happens all of the time, right? I don't know if you've had that experience with a friend or a sibling, which is much more likely. Uh, it's not a good thing, right? And that's a risk whenever you lend something out. Individuals could not pay you back and you just lose that money and the interest that they owed you. That's possible. And the final one is inflation risk. We've actually talked about this with those who are helped and hurt by unanticipated inflation. Right? The inflation risk is simple. When price level rises, it robs the value of your interest bearing asset, especially if it wasn't built into the asset in the first place. And so that can be bad as well. So you're looking at these three risks and you measure them against the returns. What am I going to get back? I'm going to get this plus interest. Is it worth it? Do I think I'm going to come out on the right side of this? If the answer is yes, if the returns are greater than the risk, then you buy it. The answer is no. If the returns are less than the risk, then you don't purchase that interest bearing asset. So there's a quick chart here to kind of define what we're talking about. This chart shows kind of the pyramid of liquidity, they call it. So at the very bottom, things are highly liquid. If they're highly liquid, it means they can be transferred into cash quickly. For example, we have checking accounts here. Checking accounts can very quickly be changed into cash, which is very different than real estate. If I'm trying to transfer real estate into cash, it's going to take a while for me to do that. I can do it, but it takes a little bit of time, it takes extra steps. So it's illiquid or not as liquid as the other. And with liquidity comes interest, right? If the liquidity is very high, you're going to have very low interest as a return, right? Because they're not borrowing the money for very long. But the higher I get on this pyramid, the more potential profit I have, or the more returns I get, the more interest I get, because there's a little bit more risk involved. High risk, high reward. You've probably heard of that before, right? So down here, we call these savings tools. I'm just putting money aside in my savings account or my CDs or my savings bonds, which is a common birthday gift and the worst gift of all time. Like, hey, here's some money. You can't use it for 20 years. Happy birthday. So we have saving bonds in there, CDs. All of those are saving tools. Let's put money aside. We're going to get very low interest on it, but it can be transferred into cash pretty quickly. Then we jump up into bonds, which we're going to spend a lot of time on. They're a little more stable, make a little bit more interest, and you have to wait a little bit longer to get paid back. Mutual funds, index funds, most of you are going to invest your money in something called a 401k. Sorry, not invest, purchase financial assets in a 401k. That's normally putting your money into a mutual fund or an index fund. You can't touch it for a while, but when you do get the payout, it's pretty significant enough to retire on. And stocks and real estate are even more risky. And then we have speculative tools. These are where you make the big money or the big losses, right? So I'm speculating. I have options. I have futures. These are things that I can't touch for a long time. I'm speculating on the future. I could hit big or I could lose big in those situations. And those are normally the big people. Those are the mutual funds that are making these giant guesses on the future, or stock market kings and queens. Okay, so that's your pyramid of liquidity. All of these are interest bearing assets. So there's a lot of it in our financial sector. Okay, but we're going to focus on something called bonds. We got to compare bonds to stocks to really understand what's going on. Bonds are securities, same thing, and they are generally speaking loans or IOUs to a federal government. They represent a debt to the government that the government owes back to the people who's lending to them. So here's how it works. When the government wants to go into debt, they need to buy a tank that they can't afford. Like, okay, we need $100 million. What they do is they issue $100 million worth of bonds. They say, hey, friends, we need money. So we're going to issue these bonds. They come with whatever the current interest rate is. So let's say the interest rate is 4%. These issued bonds, $100 million worth of them, are going to be issued at 4% interest. So we will pay you back with 4% interest in the future, right? And people like you and me say, you know what, I'm saving up for my future. I'm trying to retire at some point. And so I've heard that I should diversify my portfolio. And I've heard that bonds are very stable. And I have some stocks as well. And those are a little more volatile. So bonds it is. And so people will purchase these bonds as a financial purchase of an interest bearing asset to help set them up in the future. And what they own is a portion of the government's debt. And the government will pay them back plus interest. In fact, the United States government is the bonds that they issue are the most stable financial or interest bearing assets in the world. right? Meaning they have never defaulted or not paid a single bond in the history of the United States, which is really incredible. They are very, very highly credit rated. They are the most stable purchase of a financial asset that you can get. But when you purchase this, you don't own the government. When people say, hey, China owns 30% of our debt, they own the United States. They don't really, they just own that debt and they're owed that debt in the future, right? Uh, and then the bond holder actually gets paid that money back in the future whenever that bond, they call it matures. When that bond matures or hits the year that you purchase it for, you get paid back that money plus interest in the future. So that's what a bond is. It's lending money to the government and getting paid back in the future plus interest. Very different than a stock. A stock is also referred to as an equity because you own a portion of a corporation or a portion of a company that has gone public. So what a company does is when they want to raise financial capital, they call it, when I want to raise funds, I issue stock. And I say, hey, you can own a portion of this company and when you do that, when you purchase a stock, we get that money as an infusion of cash, and then we can use that to invest in technology or build a new facility or pay our CEOs a huge bonus or whatever. And now you own a portion of that, and you will get paid back a percentage of the profits in the future. We call those dividends. So you're entitled to a dividend in the event that you own stock. Now, most people right now, nowadays, they don't own stock for the dividends. You own stock because you speculate on it. You own it, it increases in value or appreciates in value, and then you sell it. And the difference between where you bought it at and what you sold it at is a cash out, right? You just made money, you made profit off of that. That's what most people do. They don't own the stock, hold on to it, and wait for the dividend. We don't make money off of that. But that's what a stock is. You actually own a portion of the company. So which is riskier, a bond or a stock? So let's say you purchase a $1,000 bond, which means that you borrow money or a friend owes you $1,000 plus, and they agree to pay you 10% interest, right? So you gave them $1,000 and they give you an IOU, they're going to pay you 10% every single year. Perfect. At the same time, you take $1,000 and you purchase stock. What's going to happen? Well, let's say in year one, you make $500 off of your financial assets. 100 of those dollars came from your bond because you made 10% return because you'll make 10% return every year. And then $400 came from your stocks. Like, wow, this was awesome. I made $400. Your dividend was 40% of your original invested money. That's pretty sweet, right? Great job. That's way better than the bond. But in year two, things go badly. You only make $100 off of your financial assets. Where'd you get it from? That was from your bond, right? Your bond was $100 in returns. You got 10% interest, just like you did the year before, and just like you're going to make the year after, and the year after that, and the year after that. The stock, however, that company had a bad year. They had losses. They didn't make any profits. You're not entitled to a dividend, so you made $0 off of your stock. It's kind of a boom or bust kind of situation. You jump to year three, you made $3,000 of profit. Banner year for you. Congratulations. $100 of that came from bonds. Why? Because bonds pay you 10% every single year until that bond is done. So you make $100 return on that. And 2,900 of that came from the stock because that company got it together and they just blew up. And now you're making 290% on your original infusion of cash. So what's riskier? The riskier is the stock, but you get maximum rewards with that. If you're seeking a max reward, it's a little riskier, but you want a max reward, put your money in stocks. If you want stability, put your money into bonds. So what people often do is they purchase stocks when they're young, and as they get closer to retirement, they convert those stocks into bonds because those are more reliable. And they say, okay, I know I'm going to get this consistent return. And by the time they retire, they're almost exclusively holding bonds because they're really stable and you know you're going to make the same money every time. And it's highly unlikely that the US government is going to default on that. Okay. Another thing we have to talk about is liquidity considerations. Liquidity, we talked about this, is the ease with which an asset can be converted into a medium of exchange or money. So something that is highly liquid oftentimes has a lower rate of return. You're not going to make a lot of money off of that. So when I put money in a checking account, yes, it's super liquid. But the trade-off is I might make 0.001% interest off of that checking account. And when I put something in real estate, it's highly illiquid, but I could probably make a whole lot of money off of that in the future, right? The trade-off is I get a higher rate of return on that. So it's difficult to put in transfer into cash, but I make more money off of it. Checking accounts and cash are the most liquid. We actually call them M1, which we'll get to later because they're the most liquid. Investments in future businesses are the least liquid. If I decide I'm a venture capitalist and somebody comes to me and says, I've got this great idea, all I need is $100,000. Like, you write a check, you give them $100,000. It's highly illiquid. I can't go to that startup business the next day and say, hey, I'd like to cash this out so I can go on vacation. That company will go under. You're going to tank it. So that's the most illiquid out of these. But you can make a ton of money as a venture capitalist. You just have to have billions to start with. Okay, so take a look at this, pause the video, put these in order from least to most liquid based on your thoughts. Okay, here's the key. The most liquid, number one, is a checking account, highly or easily transferred into cash. Number two is a savings account. It takes a little extra step. Oftentimes you have to go on a computer and transfer funds over, and then you can use your card or take out cash. It takes an extra step. That's two. Three is a 5-year bond. It takes 5 years to mature, so it's a little less liquid. I can cash it out earlier than that, but I'll lose some money if I do. Real estate is a number four. It's more difficult to cash out, but I can still do it. And then number five is a 30-year futures investment because I'm not going to be able to cash it out for, you guess it, 30 years. It's highly illiquid. I have to wait a very long time to get that money out. Okay, now the meat and potatoes of this portion, bonds and interest rates. So bond prices have an inverse relationship with the interest rate. This is the most important part of this entire concept and probably this entire unit. College Board has fallen in love with questions about bond prices and interest rates. So write it down. The interest rate rises, the bond price will go down. The bond price rises, the interest rate will go down. There's an inverse relationship. And really, I'm going to talk about this and explain why. It's a little complicated, but if you just remember that, you're going to be in good shape. Okay, so that's what I just said. Interest rate goes up, the price or bond price goes down. Why? Por qué? Here's why. Bonds are issued, like we said earlier, at the current interest rate. That doesn't change for the life of the bond. So if the federal government issues a bond and the current interest rate is 5%, then that bond will always have a 5% interest rate. It doesn't change. It's not variable, it's fixed for the life of that bond. So if it's a 30-year bond, at the end of the 30 years, it's still a 5% interest rate on that bond. Old bonds, however, can be bought and sold at will. So I can buy and sell old bonds anytime I want. And it's key to know that the old bonds far outnumbers new bonds. New bonds, there might be a little bit issued, but old bonds are issued all of the time. It's all of the previous years combined. So there's a ton of old issued or previously issued bonds out there in the open market. The demand changes for all of those bonds based on whatever the newly issued bonds are. If the newly issued bonds have a really low interest rate, then they're not very attractive. I'd rather have the old bonds. So I'm going to purchase the old bonds, and the price of all bonds is going to go up, and vice versa. So bond prices go up when interest rates are low. All right, let me break it down for you a little bit more so it makes sense. Think of it as a substitute asset. Remember we talked about substitute goods, right? If the price of my substitute good goes down, then I'm more likely to purchase more of my primary good. So if hot dogs and hamburgers, if hot dogs are cheaper in price, I'm going to demand fewer hamburgers. If hot dogs go up in price, I'm going to demand more hamburgers. So the substitute goods or the price of substitute goods matters. So we have two substitute assets to old or previously issued bonds. The first are new bonds. New bonds work like this. When interest rates rise, new bonds are issued at that high interest rate, and they're super attractive. So demand falls for all of the old bonds, which far outnumbers the new bonds. When demand falls for all of the old bonds, the bond prices fall. Demand goes from D1 to D2, the bond price falls. Catch that? So interest rates rose, new bonds, super attractive. Nobody wants the old bonds, super unattractive. I want the new ones with the high interest rate. Demand falls for the old ones, bond price falls. Inverse relationship. Okay. The second substitute asset is savings. I can put my money in a savings account. So if the interest rate falls, for example, savings accounts are not very attractive. Why would I put my money in a savings account? I would rather put my money in old, previously issued bonds. And so people buy those previously issued bonds instead. The demand for previously issued bonds goes up, and the price of previously issued bonds rises. So interest rates fall, substitute assets like new bonds and savings are less attractive. Instead, we demand more of the old bonds. The demand for old bonds goes up, and the price of all bonds goes up as a result. And vice versa. When interest rates rise, my new bonds are more attractive. My savings accounts are more attractive. Previously issued bonds, less attractive. I don't want those because they pay a lower interest rate relative to the new one. And so I demand less of the old bonds. Old bonds far outnumber the new bonds. So when we demand less of the old bonds, the price of all bonds falls. Again, it's a little complicated, the logic there, but if all you remember is when interest rates rise, bond prices fall. When interest rates fall, bond prices rise. You're going to be in pretty good shape. That's that inverse relationship we're talking about. Let's try an example of this. So let's say our previously issued average interest rate is 10%. Our current interest rate is 16%. What's going to happen to the demand of the previously issued bonds? Would I rather have a bond at 10% or a new bond and new savings account at 16%? The answer is I want the new stuff. So what's going to happen to the demand for the old stuff? It's going to go down. When the demand for the old stuff goes down, the old bonds goes down, then the bond prices overall are going to go down as well because the previously issued bonds far outnumber the newly issued bonds at that 16% interest rate. Okay, well, let's say the demand of previously issued bonds goes up. If people want more previously issued bonds, what must be true? Well, they must have a higher interest rate. I want the old bonds because they have a higher interest rate. So they must have a high interest rate, which means that my current interest rate must be low. Does that make sense? I want the old ones because they have a more attractive interest rate. I'm going to make more money off of them. The new ones must have a lower interest rate. And then what happens to the bond price as a result? Well, if the demand of previously issued bonds goes up, the previously issued bonds far outnumber new bonds, so the bond price goes up as well. Let's take a look at this next one. Current interest rates are 4%. Old interest rates are 8%. Which is more attractive? Of course, it's the old one. So the demand for the previously issued bonds goes up, and that price goes up along with it. Let's try the next one. If the current interest rate is high at 10%, the old one is 6%, which is more attractive? Of course, it's the current one. So what's going to happen to my demand for the old one? It's going to go down. When the demand for the old one goes down, bond prices go down. Now, all of these I've shown interest rate leading the way, but the opposite is true as well. If bond price rises, then interest rates fall and vice versa. Okay? Know that relationship. Know it well. That's the end of that concept. Check out the Khan Academy 4.1. I know that was a lot. Get that relationship under your belt. Look at those definitions, and I promise you, you will get through it sane. Talk to you